Hi, this is Mark Pizzacalla and welcome to Legalwise, what you need to know with Dr. Mark for September 2024. And what I want to talk about today is buying a business versus buying shares. And you might say, well, what's so exciting about that? Well, you'll know from last month's episode that there's a lot of considerations about selling a business. Let's look at buying one. Now, when you're buying a business, you can buy the assets of the business, called an asset sale or purchase, or you can buy the shares of the company. And there's real different implications and complications that occur. I'm going to look at a few of them. For example, if you're buying the assets of a business from a company, you're usually only acquiring the liabilities that attach to those assets. Similarly, with employees, you'll be taking on usually employee liabilities. But where you're buying the shares of a company that's running the business, then in that case, you'll take on all of the historical liabilities of that company. So you need to be really clear about what they are, and you'll probably want some sort of indemnification process in place as part of your contract. Stamp duty is another consideration. If you're buying assets of a business, stamp duty will usually apply particularly to the land components. If you're buying shares, again, there could be a landholder's duty. So either way, there might be different stamp duty implications that you need to consider. If the business is making losses or has made losses, if you're buying the assets of the business, you won't be able to access those losses as a buyer. However, if you buy the shares of the company that's running the business, you may be able to access those losses as long as you're able to satisfy the company loss recoupment rules in relation to those losses. GST is also a consideration when buying a business. If you're buying the shares, GST is usually not included in that price because it's an input taxed supply. However, if you're buying the assets of the business, a business sale from the company, in that case, there will be a GST component when you're buying the assets of the business. The seller and the buyer can agree for the business to be the sale of a going concern, which usually happens when the seller provides all of the things that are necessary to run the business to the buyer. But of course, that is also negotiable, and quite often the seller will want to sell for the sale price plus GST because they don't want to be caught out in an ATO audit. And last but not least, if you're buying the shares of a company, you may be able to negotiate better on the purchase price because the seller of the shares might be able to get a 50% CGT discount, and so they may prefer to sell you the shares rather than the underlying business from the company. So that could be a good negotiation technique. So look, overall, as you can see, there's a lot of pros and cons about which way you go. There's a lot of financial considerations, tax considerations, and importantly, commercial considerations, because whichever way you take, it's got to make commercial sense from your perspective as the buyer. Look, thanks for listening, and if there are any questions, by all means, let me know. Speak to you soon.